15 is specific to corporations. Learning Objective 1 starts off talking about the corporate taxable income formula. You know, read through that. I think there's not going to be any surprises there. And it also talks about accounting periods and methods, specifically with regard to corporations. Corporations are typically accrual basis taxpayers. There are some provisions, though, allowing them to use the cash basis. I'm going to move right into Learning Objective 2. That talks about computing corporate regular taxable income. Now, the biggest thing that we have to really get good at in this chapter is the understanding of book tax differences. GAAP provides, generally accepted accounting principles, provides our rules for calculating book income for financial statement purposes, but the Internal Revenue Code and other sources provide our rules for determining taxable income, and a lot of times those rules are different, so it produces book tax differences between financial statement income and taxable income. And we'll see that these differences are either unfavorable or favorable. Unfavorable differences are when you have an item that has different rules for book and tax, and the tax rules cause you to have to increase taxable income above what the book income amount was. Okay, so that can take the form of income items that are taxable but weren't included in the books, or it can be expenses for book purposes that are not deductible for tax. Both of those are unfavorable differences. Favorable differences are just the opposite. This is when you've got income that was recorded on the books but isn't taxable, and when you've got expenses that, or I should say deductions on the tax return that were not on the books or were lower expenses on the books. So this learning objective goes through a whole bunch of specific book tax differences and discusses them in detail, and it also gives you a big look at what some of the more common differences are. The differences are further broken down between permanent book tax differences and temporary book tax differences. Permanent book tax differences are items that are never going to reverse. That is, they will run the difference will either go through the tax return or through the financial statements, but never both. The most common example of this is probably meals and entertainment. Only 50% of meals and entertainment costs are deductible for tax purposes, but all that amount goes through the books as an expense. So that 50% that's non-deductible will never be deductible, and so it's said to be a permanent difference because that 50% will always go through the books whenever it's incurred, but it'll never be deducted in the tax return. Timing differences or temporary differences are called that because they will eventually be reported on both the tax return and the financial statements. It's just a matter of when. Depreciation is probably the most common example of this. You use straight line depreciation typically for book purposes. For tax purposes, companies usually use accelerated method, double declining balance. That doesn't change the overall depreciation deductions on the asset over its life, but it does change the amount each year. So each year you have differences, but in total you will deduct the same for book and tax. So the differences each year are temporary. This learning objective goes through common permanent book tax differences. You can read through those a little bit. We're going to see a lot of interest income from municipal bonds. Those are never taxable. Premiums paid on key employees are insurance premiums are not deductible if the corporation is the beneficiary. Meals and entertainment that I just told you about, half of that's never deductible. And the domestic production activities deduction, it's a made-up deduction, so companies will produce goods in the United States instead of shipping jobs overseas. That is not a book expense at all. It's a tax deduction that the government has generated for companies that do that. And then federal income tax expense. Companies estimate their federal taxes every year. You can't deduct federal taxes in figuring out federal taxes, so any federal tax expense has to get added back too. We'll continue in the next video.